This LOS is determine the initial recognition, initial measurement, and subsequent measurement of finance leases. So we're just going to walk through some of the accounting now with regards to the lessee, okay? And so this is the example in the text. I'm using the exact same numbers. And by the way, these numbers never changed since 2001 when I studied the CFA Level 1, except that they changed the dates, they updated the dates, and it used to be in US dollars and they changed it to euros, okay? So the example is Cap BS, that's capitalized balance sheet, because the asset's going to show up on the lessee's balance sheet, so it's being capitalized. Enters into a lease agreement to acquire the use of a piece of machinery for 4 years, beginning on January 1st, 2010. The lease requires 4 annual payments of 28,679 euros, starting on January 1st, 2010. The useful life of the machine is 4 years. Its salvage value is 0. Cap BS accounts for the lease as a finance lease. The fair value of the machine is 100,000 euros. The present value of the lease payments, using the company's discount rate of 10%, is also 100,000 euros. A reminder is relevant for the present value calculations. Lease payments are made at the beginning of each period. The company uses straight-line depreciation. Okay, so up here we have a little bit of a table, and I'll just cross it off. We'll start first with the easiest part. So the lessee, it's a finance lease, so the lessee is going to take the asset on their books. Assets equals liabilities plus equity. They've got the asset, okay? The asset's going to increase. The liability is going to increase with the lease liability, okay? So we're going to debit asset 100,000. We're going to credit the lease liability 100,000. That's our debits and credits, okay? So we've got the asset. We need to depreciate it. So it says 100,000 minus 0 salvage value divided by 4. They're using straight line depreciation. The depreciation expense every year is going to be 25,000. So let's get that calculation out of the way quickly. You can see that's in a very easy one. There should be no issues understanding that at this point. So we can see that at the end of year 1, we've got the net book value 75,000, 50,000, 25,000, and at the end of year 4, we don't have the assets been fully depreciated, okay? So the next thing, we need to look at the accounting for the lease and with regards to the payments. So let's start here, the beginning of 2010. The liability is 100,000 euros, okay? And it says that the payments, there's going to be 4 equal payments of 28,679. I did a little bit of rounding. I've got 2 decimals there, okay? So the first thing that, if you look at, I got a piece of equipment that's 100,000, but I'm paying back 114,717 euros, okay? So why is that? Because as we've said, a finance lease is just like borrowing money from the lessor, not from a bank. So I'm paying back, to pay back the loan, 100,000, and some interest. And the interest is at a rate of 10%, okay? So we can see that if the liability is 100,000, and I paid 114,717, then I've got interest. It's going to be 14,717 in interest, okay? So what happens here then, this table, if you've been familiar, so we're getting into leases. Some students say, well, it's kind of difficult to understand, but if you've ever done a loan amortization table, which a lot of students have done in basic accounting courses at lower college or university levels, folks, this is just a loan amortization table. We start with 100,000, but in this case, the payment is made at the beginning of the year. So 100% of that payment goes to reducing the reduction of the liability. So our liability at the end of the year is 71,320.84. That becomes our liability at the beginning of the year. Payment never changes, but now I've got some interest. Where did that interest come from? Well, I made this payment right at the beginning of the year. So this was my liability for the entire year times 10%. The interest rate was 10%. So you can see that it was my interest from the first year. So this table up here is cash flows, okay? But down here you can see in year 2010, I would have had an interest expense. I would have had an interest payable at the end of the year, correct? I would have had my depreciation expense, and I would have had debit interest expense, credit interest payable. Then in 2011, when I make that payment of 28,679.16, that means 7132.08 is for the interest, the remainder is for the principal, and therefore the liability comes down to 49,773.76, which, don't forget, that's my liability. These payments are being made at the beginning of the year, so that's my payment that's my balance at the beginning of the year, 49,773. Okay, so that's why the interest is 4977.38. So you can see there's just a timing issue. These are cash flows up here. Okay, this is cash flows with regards to the actual payment. But here, down here is my accounting on my income statement. I'm going to have depreciation expense every year of $25,000, very easy to understand. And then I'm going to have an interest expense, also fairly easy to understand. $100,000 liability at the beginning of the year, paid the first payment. That means I had a balance of $71,320 since the beginning of the year, times 10%. I've got an interest expense. So there's my total expense with regards to a finance lease. So what we've mentioned before in the previous slides, you can see that with any loan, as I pay off the loan, more and more of the loan, the principal comes down, the interest comes down, and this is the whole point with regards to the early years and the lesser years, that you can see in the final year, I don't even have any interest expense, okay? So my expenses with regards to the lease are coming down. They start at 32,132.08, and they end at 25,000, okay? So you can see in the early years, that's more than the operating payment of 28,679, and at the end of the lease, it's less. So that's why in the early years, a finance lease is less profit, it's more expensive, lower net income than an operating lease, but in the later years, it's more profitable. That's what we looked at in the previous slides, okay? So again, this is not too difficult to understand. Just remember in summary, when the lessee takes on a finance lease, they've got the asset, they've got the liability. Asset goes up, liability goes up. So 2 points. Let's start with the asset. We need to depreciate it. We're going to have a depreciation expense every year. Second thing, we've borrowed money. We're going to pay the lessor more than the value of the asset because we're including some interest. So we've got an interest expense every year, okay? As the loan gets paid off, the interest expense starts to decrease, so the expense will go down over time with regards to a finance lease. Okay, this slide is maybe a nice to know, not a need to know, but I've done all the debits and credits for the lessee for the first 2 years. And this is not something that you see in the text, but there's some accounting people out there that really want to understand this 100%, so why not, you know? So you can see that we start with we're looking at the lessee's point of view, and it's a finance lease. So as we've always said, they get the asset goes up and the liability goes up. So you can see we've got the leased asset for 100,000 euros, and our lease liability has gone up for 100,000 euros. So that's pretty clear. That's an easy first one. Then that first payment is made. Again, the payment's made at the beginning of the year. You need to be careful with that because the payment's made at the beginning of the year. So I always say start with cash, credit cash. That's easy to understand. And we're going to debit the lease liability 100% because there's no interest accrued, okay? So the way I put this number here, the 71,320.84, that's the balance of the lease liability now, okay? That's the 100,000 minus the 28,679.16. So then we get to the end of the year, the 31st December, we're going to have our depreciation expense. The asset was 100,000, no salvage. And so the depreciation expense was easy, recall. Debit depreciation expense, 25,000, credit accumulated depreciation. But at the end of the month, end of the year here, we also have the interest expense. We made the payment at the beginning of the year, but there's an interest expense. Remember, when we're paying on a finance lease, part of the payment is principal, part of the payment is interest. And how do we calculate that? We use the interest rate, 10%, times the balance on the lease liability. So that's also why I put that there, because 10%, I don't even need my calculator. We can see debit interest expense, 7132, credit interest payable, 7132, okay? That's the balance times the 10%, easy. So that's all the transactions for the first year. Now we get into the second year. I'm going to make the payment, start with the payment again, credit cash, that's easy to understand. But now I got to debit my interest payable. Okay, so there was a credit interest payable. Now I'm debiting interest payable. The rest is a reduction in the lease liability. Okay, so you can see 71,320 minus 21,547. There's my lease liability there as well. I wrote it for you. So you can see that was the calculations for that. Again, the end of the year, I'm going to have the depreciation expense. That doesn't change. Debit depreciation expense, 25,000. Credit accumulated depreciation. And I'm going to have my interest expense and interest payable again. My interest expense is 10% times the balance on the lease liability. So that's easy to understand as well. That's why I put those numbers there. And that's it. Those are the debits and credits for a lessee on a finance lease in the first 2 years. Took 3 minutes. It's not in the text. It's a valuable 3 minutes. Thank you. Okay, the reason why I put it into Excel is that you can put it side by side a little bit easier than in the text. The numbers are kind of spread out over a couple of tables and a couple of pages. It's hard to go back and forth and compare. So here I'm on this slide I'm going to look at the income statement. The next slide I'm going to look at the cash flows. Okay. And this is from the point of view of the lessee. So here we have the Cap BS, which is the capitalized balance sheet. And here we have Opus, which is the operating, if it was just a operating lease. And so we can compare the two side by side. And the first thing that I'm going to start with is that you can see the total net income over the 4 years is the same, regardless as if it was a finance lease or an operating lease. And that's mentioned in one of the first slides, is that the cash flow and the net income over the term is the same. The next thing that I'm going to show is that a reminder that the net income in the early years for the capitalized lease, because I mentioned we've got the depreciation and the interest, which is more than just the lease expense, the rental payment in the early years. So our net income is lower on the finance lease than in the early years. Okay, so now this is giving a nice comparison, because on the previous slide we went through the calculations of how we got that interest of 713208, 4977.38, and 2607. There's our interest, the 14716 over the 4 years. Okay, we understand that. And there's our depreciation expense as well over the 4 years, the 100,000. So if we start now with the income statement for the capitalized balance sheet, this sales 50,000, that's just a made up number. So we know that if I'm capitalizing it, I've got the depreciation expense. We saw that on the previous slide. Then I've got my interest expense, which is going to give me an EBIT. I'm going to have a tax, and then I'm going to have my net income. Over here if it was an operating lease, I'm going to have the same sales, 50,000 euros, no depreciation. I don't have the asset on my books, okay? But I'm going to have a lease expense. I'm renting here, I'm renting it. And it's going to be the same payment every year, the 28,679. So again, I have the same total, 114,716, and the same net income over time. But my income statement, I'm going to have higher net income in the early years and lower net income in the later years, okay? And I'm going to have higher tax in the early years. Actually, my tax doesn't change, okay? My tax doesn't change. Here I've got lower tax in the early years and higher tax in the later years, okay? My tax doesn't change. And you can see that's one nice issue, is that with an operating lease, all my numbers don't change because I'm just paying the exact same amount of rent every year. So my net income is the same, my tax is the same. It's a fairly easy income statement to understand. So the key thing is, as I said, the main thing is with the finance lease, you just have to understand I've got the assets, so I've got the depreciation, but I've borrowed money, so I've got some interest expense. The interest expense grinds down over time. It becomes less. So my net income in the early years is less than an operating lease, and it's higher in the later years. But in sum total, my net income over the 4 years is exactly the same. So now we're going to look at the cash flows from the point of view of the lessee again. At the top, we have the capitalized balance sheet. So this is the finance lease. And below, we have the operating lease. Okay. So we can zoom in on a couple of things right away, just to get that out of the way. We can see that both the total change in cash is the same. It's just a timing issue once again. Same thing with the net income. It was the same over the total for the 4 years between the finance lease and the operating lease. The net income was the same. Same with the cash flows, okay? But there's timing issues and there's categorization issues. So up here we've got in the operating cash flows and we have the financing cash flows. So let's start with the easier one, get it out of the way. If we look at an operating lease, we're not going to have any financing cash flows. It's just 100% rent payment. $28,679 was our annual payment every year for 4 years, okay? And as I said, the operating lease is nice to understand because the payment's the same every year, so my taxes are the same, my net income is the same, and my cash flows are all the same. So that's why I said if you understand the operating lease, it should be easy to understand, okay? So that is, and again, that lease expense, that rent expense, is all coming out of operating cash flows. So that's the thing to realize, is that if I compare my operating cash flows up here on my finance lease, they're going to be higher than on an operating lease. Why? Because on my finance lease, my cash flows are split between the interest paid and the payment to reduce the lease liability, which are classified as a financing cash flow, okay? So that's the key thing to understand. I think it's pretty easy to understand the operating cash flows. It's just a rent expense, okay? And it's the same every year. So my operating cash doesn't change, my net income doesn't change every year, and it gives me a total that's the same as the finance lease. But with regards to the finance lease, as we've mentioned, we're going to pay less taxes in the early years, more taxes in the later years. We're going to pay more interest in the early years and less interest in the later years, okay? But cumulatively, we're going to end up in the same place. And on a finance lease, my cash flows are split between interest, so my operating and financing. So my operating cash flow is higher than an operating lease. And finally, from the point of view of the lessee, we're going to look at the retained earnings, common stock, shareholder equity between a finance lease and an operating lease so that we can calculate the ROE, okay? And as we said, the ROE on a finance lease is less in the early years, but more in the later years. And so you can see that because I showed, I just copied from the previous slide. Here's a little reminder of the net incomes. It's easy to, it's easy to understand the operating lease. The net income is the same amount every year, but the net income on the finance lease, because we've got interest and depreciation, and the interest is higher in the early years, the net income is lower on a finance lease in the early years. It's higher in the later years. So as goes the net income, so goes our ROE calculations, okay? That's what you need to understand. And I just did a little reminder down here again on the operating cash flows because they like to ask questions about that. You can see the operating cash flows are always higher on a finance lease than on an operating lease because on a finance lease, the cash flows are split between interest payments and principal payments, but on an operating, it's just 100% rent, okay? So I don't really need to scroll through the entire shareholders equity section, but you can see here, here's my retained earnings is lower on the finance lease than on the operating lease. Okay, so a little bit difference in the shareholder equities, but as I've said many times throughout many slides, as goes the net income, as goes the return, so goes the ROE or ROA calculations, okay? So that's just what you have to remember. This section here is a nice to know, not really a need to know. What's important to know is that the ROE, the net income, and the operating and financing cash flows, okay? Another nice thing about putting into Excel is that I did a couple of graphs here because sometimes people say a picture's worth 1,000 words. And again, this is from the point of view of the lessee. These are my graphs. They're not in the text. And I just wanted to show you that the ROE on an operating lease starts higher than on the finance lease. So you can see blue is the capitalized balance sheet, red is the operating, and they cross over. And so there's quite a few potential questions that they could ask you about the early years, later years, most likely. And so I like to just draw a little graph like that. And we know that the ROE on the capitalized is lower in the early years. Why? It's easy to understand. I've got depreciation plus interest, and that's more than just the straight operating rental payment, because my interest starts higher and it grinds down over the lease, okay? And again, as goes my net income, so goes my ROE, okay? And then, of course, the operating cash flows are higher on my finance lease than on my operating lease, because this is 100% rent. So that's just a couple of graphs that I did, because sometimes people can improve their memory skills by drawing a little bit of a graph and then remembering, oh yeah, that's the finance lease. It's lower in the early years than in the, so this is years and this is percentage. Lower in the early years, higher. Why? I understand why. And then I can answer any type of question that they've given me, most likely, least likely, early years, later years, etc. Okay? So now we're going to look at some of the differences with regards to the balance sheet and income statement and some of the ratios between a finance lease and an operating lease. So when you have a finance lease, the lessee is going to take the asset onto their books. So assets equals liabilities plus equity. If you have the asset on your books, your asset is going up and your liability is going up, okay? So your assets are higher under a finance lease versus an operating lease where they're lower. So as I said, if your asset's going up, your liabilities are going up, so your liabilities have to be higher, okay? And then when I have the asset on my books, the way to look at it, it's pretty easy to understand, in fact. It's like the lessor is giving me a loan to purchase, okay? So I have interest expense for example, because I've borrowed money, and I have the asset and I have a depreciation expense. So I have interest and depreciation, okay? So that means my net income in the early years is lower than an operating lease. And the reason is because the depreciation and interest expense in the early years is greater than the operating payments. But what happens with a loan over time? With a loan over time, the interest rate decreases, okay? The interest expense decreases over time. So in later years, the depreciation and interest is less than the operating payments. So in the early years, the net income on a finance lease is lower, but it crosses over and it's higher in the later years. The total net income over the life is the same. It's just a timing issue, okay? Cash flow from operations is higher under a finance lease, lower under an operating lease, because with a finance lease, the payment is split between principal payment and interest payment, where in operating lease, 100% of the payment is cash flow from operations, okay? So we're going to have a lower cash flow from operations with an operating lease, which I think is easy to understand. It's 100% like a rent payment, okay? The cash flow from financing, though, is going to be lower with a finance lease and higher for a operating lease for the exact same reason. But the total cash flow is going to be the same. So again, that's just a classification issue. So again, in summary, the way to think of a finance lease is that as the lessee, I need to take the asset onto my books. So assets equals liabilities plus equity. If I have the asset on my books, my asset's going up, my liability is going up, okay? And I'm being financed. I'm making annual payments for 5 years, 10 years. So those payments, just like a mortgage or a car payment, have got an interest component. I'm paying back principal, I'm paying back interest. The total amount of the payments is going to be more than the initial value of the asset, okay? Because I'm paying interest. So in the early years, I have depreciation expense and I have interest expense, okay? And that's going to be greater than an operating payment, which is just like a rent. But interest comes down, interest expense comes down as the loan is ground down. So in the later years, I'm going to have a higher net income versus a operating lease, okay? So it takes a little bit of work at the beginning to understand the leases, but at the end of the day, it's not that hard. Just think a finance lease, I've got the asset, A goes up L goes up. Oh, I've got the asset and I'm borrowing money to get it, so I've got depreciation and interest. That's more than a rental expense. So moving on now to look at some of the ratios for the lessee, and these are from the lessee's point of view. I've got the asset on my books equals liabilities plus equity. So as I've said, my asset's gone up and my liability's gone up. So you can see, always look at your numerator and denominator, what's happening. My asset turnover is going to be lower because my assets are higher, okay, under a finance lease. So under an operating lease, my asset turnover is going to be higher. Return on assets, okay, as I've mentioned before, and I'll mention again, as goes the net income, so goes the ROA and ROE. So in the early years, as I said, you've got that interest and depreciation expense, which makes my expenses higher than an operating straight out rent in the early years. So my net income is lower. That means my return on assets is lower in the early years. Similarly, my ROE is going to be lower, okay, in the early years. My debt to assets is going to be higher. Why? Look at my debt. My liabilities has gone up. Even though my assets and my liabilities has gone up, my debt to assets is going to be higher under a finance lease. And my debt to equity is going to be higher as well because I've got the higher debt. So again, down here, I've just a little bit reminder. Assets equals liabilities plus equity. Finance lease, increase A, increase L. Early years, the finance lease, the net income is less than the operating lease, so the numerator is a smaller percentage. Denominator, big for ROA. Lower net income is lower ROA, lower ROE. And that's the last slide for this LOS. Thank you. Okay, let's do a practice question. This one's a little bit tricky. Assume US GAAP applies unless otherwise noted. At the beginning of the year, a lessee company enters into a new lease agreement that is correctly classified as a finance lease with the following terms. The annual lease payments due at the end of the year is $100,000. The lease term is 5%. The appropriate discount rate is 12%. The depreciation method is straight line basis, and the salvage value is 0. With respect to the effect of the lease on the company's financial statements in the first year of the lease, which of the following is most accurate? The reduction in the company's pre-tax income is $72,096. Cash flow from financing is $56,742, or the cash flow from operations is $72,096. Okay, a bit of a tough question. We really haven't seen one like this before. And there's a couple of steps that you need to do, so within a 90-second time frame, it's a little bit challenging. But once you've been through it once again, as I said, it's not going to be too bad. So they're giving you the annual lease payments due at the end of the year, okay? They're not giving you anything with regards to the value of the lease. So we have to calculate the value of the lease, okay? So let's bring up our calculator. And so we know the future value is going to be 0. We have our payments, $100,000 per year at the end of the year. So I'm in the ending mode, payment. Okay, the interest rate is 12%, 12 IY, and it's a 5-year lease, 5N. So I'm going to compute the present value, and I'm going to get $360,477.62. So that's the present value of the lease. So we know assets equals liabilities plus equity. I'm going to increase my asset by $360,477.62, and I'm going to increase my liability. Okay, but we're not done yet because we're looking for what the impact is on the pre-tax income, the cash flow from financing, the cash flow from operations. So this question, you really have to understand your leases, exactly what's going on. Okay. So this is an interesting one because the payment is due at the end of the year. The end of the year, okay? So again, using my calculator keystrokes, I can just click on the plus or minus key and keep going because I'm going to calculate my interest for the year. I can just multiply by 0.12, and now I've got my interest for the year, which is $43,257.31, okay? So that's my interest. So now I know when I make that lease payment at the end of the year, I have an interest component already and I have a principal component, okay? So we can see, just let me bring up the calculator again. If that's the interest, and I, again, just carrying on with my keystrokes, make that a minus, and I add 100,000. See, this question is not that bad if you practice it. You can see then my financing cash flow is, just bring that up again, 56,742.68. Aha, the cash flow from financing equals 56,742. So B is the correct answer, okay? So what we needed to do, step one, we had to do the present value of the lease payments to get the value of the asset and the liability. Step two, the payment was made at the beginning of the year, so we calculated the interest, which is just the interest rate times that present value calculation. Step three, when we looked at the $100,000 payment, we subtracted the interest and we had the principal, and as we know, that's cash flow from financing, okay? So depreciation then, if we want to, so just to see why the other, so you've got it then, but if you wanted to check why the other answers are not right, depreciation, it would be the $360,477 divided by 5, there's no salvage value, or $72,000. So the reduction in pre-tax income, as we've always said, in the early years, you've got the interest and the depreciation. So you can see the interest and the depreciation is $115,000, not $72,000, so A is wrong, okay? And also, the cash flow from operations would be reduced by the amount of the interest only. And the interest only is the $43,257 because the depreciation is a non-cash item and it's added back. So the cash flow from operations number is wrong as well, okay? It's just the interest. So that's an excellent little lease question. Very good practice. You have to understand the calculations and you have to understand exactly what's going on with regards to the interest and principal. Okay, now we're going to go through the same kind of analysis that we did from the point of view of the lessee, but now we're looking at the lessor, okay? So here's a direct financing lease, and here's an operating lease. So let's start with the operating lease again. Remember, if it's an operating lease and I'm the lessor, it means I have the asset on my books. So I've got the depreciation expense, okay? Then I've got my lease revenue, which is my $28,679. Okay, this slide is a bit of a nice to know, not a need to know. These debits and credits are not in the CFA text. And now we're looking at the debits and credits for the lessor for the first 2 years, okay? So we know that the lease receivable is going to be $114,716.66. That's the $100,000 for the equipment plus the interest. We saw that from the table before, okay? Now, we're going to have a liability of an unearned interest revenue at the beginning of the year, and the machine, we own the machine and it's gone, it's going off our books. Assets equals liabilities plus equity. We've just entered into a finance lease, so the asset's gone down, okay? And the liability will have gone down. And this makes it gone. So we're going to credit, so I just showed you here, asset, we've got a lease receivable, we're going to credit unearned interest revenue, and we're going to credit the asset, it's gone, okay? Then we're going to receive that first payment. The cash payment is always the same, the $28,679, that's debit cash. We're going to credit the lease receivable, and at the end of the year, we're going to debit unearned interest revenue, and we're going to credit our interest revenue. Remember, from the lessee's point of view, they had an interest expense and an interest payable. We're going to debit, so we're the opposite side of that. We've got interest revenue, and we're going to debit the unearned interest revenue, okay, which we had up here. Then the beginning of the following year, we're going to receive our cash in again on that payment, and we're going to decrease the lease receivable. And at the end of the year, we're going to debit the unearned interest revenue and credit our unearned interest revenue. So that's a bit of a nice to know, not a need to know. It's not exactly in the text, but I just wanted to put these two slides on the debits and credits for the first 2 years from the lessee and the lessor, just so that there's removes any doubts from some people that really love the accounting. Now we're going to look at the cash flows from the point of view of the lessor between a finance lease and an operating lease. Again, let's start with the operating lease because it's maybe a little bit easier. Okay, so we know that the cash flow is going to be the exact same every year, and the total is $253.01. Okay, and so we've got our net income, add back our depreciation, There's our operating cash, and we can see our operating cash flow under an operating lease is going to be higher than under a finance lease. Why? Because with the finance lease, I'm going to be receiving payments, and those are the payments received on my lease. That's going to be categorized as investing cash flow. So you can see in the first year, 100% of that first payment was paying back the liability, but then I'm going to be collecting interest, and the rest of the payment is going to be paying back the principal. So you can see the $100,000, the investing cash flows, I'm getting my $100,000 back. Okay. The interest is included in my net income, don't forget. All right. So the investing cash flows on a finance lease, of course, I'm going to get my $100,000 back. Here on an operating lease, no. It's just a rental payment. So of course my operating cash flows under a finance lease, under an operating lease, from the point of view of the lessor, are going to be higher than under the finance lease. Same type of analysis here. We've got the net income on the direct finance lease and the net income on the operating lease. We can see on the finance lease, the net income is lower from the lessee's point of view in the early years. So it's higher from the, I don't have the asset on my books because I'm the lessor on the finance lease. So my net income is higher in the early years. So therefore, my ROE is going to be higher in the early years. It's the exact opposite, okay? And you can see with regards to the operating cash flows, of course, it's a finance lease. I'm getting paid back principal and interest. So my operating cash flows from the point of view of the lessor are going to be higher under an operating lease, okay? And again, there's going to be a crossover because it's the same pattern. Later on, the operating lease is going to have the higher net income. The operating lease is easy to understand. That net income never changes, but here the interest payments are coming down. So my net income from the point of view of the lessor is coming down. So in the later years, my ROE is going to be lower on the finance lease than on the operating lease. Again, a picture's worth 1,000 words perhaps. Start with the net income. So we can see the net income on an operating lease is lower in the early years. It's higher on the finance lease because remember, just always start with one. If I like to start with the lessee and then to flip it to the lessor, I'm just thinking the opposite. So that's why I'm saying that sometimes. I know that from the lessee's point of view, in the early years, my net income is lower on a finance lease. So from the lessor's point of view, it's going to be higher, okay? And if I have higher net income, I'm going to have a higher ROE. Now, with regards to the cash flows, of course, this is easier to understand. Now I'm looking from the point of view of the lessor. An operating lease is 100% rent, so my operating cash flows from the point of view of the lessor for an operating lease are going to be much higher. Now we're going to look at the lease from the point of view of the lessor, okay? And this is not too difficult because it's just the exact opposite from the point of view of the lessee, okay? So just a quick review. If it's a finance lease for the lessee has the asset, so the assets are going to be higher. From the lessor's point of view, it's going to be lower, okay? If it's a operating lease, from the point of view of the lessor, the asset is still on the lessor's books, so their assets are going to be higher, okay? So if I've got the higher assets, again, assets equals liabilities plus equity. If I've got the higher assets, I've got the higher liability. I've got the lower net income in the early years. I've got the net income in the later years is going to be higher. Total net income over the life is going to be the same. Cash flow from operations is going to be higher on an operating lease. And my cash flow from financing is going to be lower. Of course, here I'm getting paid back my principal, so my cash flow from financing is going to be higher, okay? Because it's a finance lease. The lessee has the asset, and I'm getting back my interest and my principal, so my cash flow from financing is going to be higher than on an operating lease where I'm just collecting a rent payment. And again, it's the same story that the total cash flows over the 4 years is going to be the same, okay? And the total net income over the life is going to be the same. It's just going to be a timing issue. So just carrying on now with some of the ratios from the lessor's point of view again. So always go back to assets equals liabilities plus equity, and just remember where that asset is. So from the lessor's point of view, if it's an operating lease, they still have the asset on their book, okay? So the higher asset, you're going to have lower asset turnover. The return on assets is going to be lower, okay? Return on equity is lower because remember, I have the lower net income in the earlier years, okay? And my debt to assets is going to be higher. My debt to equity is going to be higher. So remember, if it's a finance lease, I don't have the asset on my books, okay? And so it's the opposite. I'm going to have the higher asset turnover, and I'm going to have the higher return on assets in the early years, the higher ROE, lower debt to assets, lower debt to equity. Okay, one last practice question to finish this LOS. It's been a long one. Assume U.S. GAAP applies unless otherwise noted. On January 1st, 2008, a company enters into a lease agreement to lease a piece of machinery as the lessor with the following terms. Annual lease payment due 31st December, $75,000. Lease term, 6 years. Estimated useful life of the machine, 7 years. Estimated salvage value, 0. Carrying value cost of the leased asset, $300,000. Implied interest rate on the lease, 7%. The firm is reasonably assured of the collection of lease payments. The total effect on 2008 pre-tax income for the lessor from this lease is closest to A, $32,143, B, $75,000, or C, $82,519. Excellent question to finish this LOS with. I'd call this a 5-star because it puts you through your paces again. So they've given us the annual lease payments and they've given us the carrying value. But the first thing that we need to do is check whether it's a sales type lease. We know it's a financing lease because 6 out of 7 years, okay? So let's just bring up our calculator. We're going to have to do the present value of the lease payments. Okay, so let's just make sure that I'm in PY equals 1. Correct. So 0 future value on the lease. The payments is $75,000, and that's at the end of the year, so I'm in the ending mode. That's our payment. Our interest rate is 7%, 7 IY, and the lease is for 6 years, 6N. So when I compute the present value, I've got $357,490, okay, which is more than the carrying value of my asset, okay? So that means it's a sales type lease and I'm going to have a profit on it, okay? So now when we do our assets equals liabilities plus equity, I'm the lessor. That asset is going to the lessee. It's going to go to the lessee at a value of $357,490. Their asset goes up and their liability goes up by $357,490, okay? So you can see this payment is due at the end of the year, So again, if you're good with your calculator keystrokes, I hit the plus or minus key, and the interest rate is 7% times, we know what the interest expense is going to be for the lessee. It's going to be $25,024, okay? So we can calculate that fairly quickly, okay? So our interest, $25,024. Interest is $25,024, and we made a profit on the sale of the asset, $357,490 minus the $300,000. So we made a profit of $57,490, and that's what is going to be our total effect on our pre-tax income for the lessor. Is going to be a combination of the interest plus the profit that I made because it's a sales type lease. So just bring up my calculator. I have my interest calculation still there, $25,024. I'm going to add my $57,490, and it's going to give me $82,514, okay? $82,500, well, it's close enough with a bit of rounding. It's closest to, they're going to give us the word closest to, it's closest to C. So nice little question. Step 1, you have to do the present value of the payments. Step 2, determine that it's a sales type lease. Step 3, calculate the interest. It's the annual payments at the end of the year, so it's just the present value times the interest rate for the interest receivable, in this case from the lessor's point of view. And then step 4, calculate what the profit was on the lease, which is the present value, minus the carrying value of the cost. So it says here the firm must have acquired or manufactured the asset if it recorded it at less than the present value of the lease payments. That's something to be aware of, okay? And so therefore that question is not too bad, but you just have to know what steps you need to go through. The calculations aren't that bad, but it's just when they're throwing you a lot of information like this and then asking you what the effect on pre-tax income is. Sometimes it's effect on a ratio or effect to the income statement or effect to the balance sheet. You have to think, what are my steps to work through the calculation? Step 1, step 2, step 3, step 4. And that's the last slide for this LOS. Thank you.